Ladies and gentlemen, good day and welcome to Apollo Hospital Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Devrishi Singh from CDR India. Thank you, and over to you, sir.
Thank you, Yusuf. Good morning, everyone, and thank you for joining us on this call hosted by Apollo Hospitals to discuss the financial results for Q2 and H1 FY2026, which were announced yesterday. We have with us today the senior management team represented by Mrs. Sunita Reddy, Managing Director, Mr. A. Krishnan, Group CFO, Dr. Madhu Shashidhar, President and CEO of the Hospitals Division, Mr. Madhivanan Balakrishnan, CEO of Apollo Healthco, Mr. Sriram Iyer, CEO of AHLL, Mr. Sanjeev Gupta, CFO of Apollo Healthco, and Mr. Obul Reddy, CFO of the Pharmacy Business. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature and may involve risk and uncertainties. Please note the disclaimer mentioning these risks and uncertainties on slide number 2 of the investor presentation shared with all of you earlier. Documents relating to our financial performance have been circulated earlier, and these have also been posted on the corporate website. I would now like to turn the call over to Mrs. Sunita Reddy for her opening remarks. Thank you, and over to you, ma'am.
Good afternoon, everyone, and thank you for taking time to join our earnings call. I believe that you have received the earnings documents which we shared yesterday. Consolidated revenue was at 6,304 crores, a 13% year-on-year growth. Consolidated EBITDA was at 941 crores, registering an increase of 15% year-on-year. Within this, the healthcare services EBITDA was at 781 crores, registering a growth of 8% year-on-year, and healthcare services margin remained robust at 24.6%. We are pleased to talk about the sustained and strong momentum for Q1 into Q2, delivering strong growth across all three verticals: healthcare services, Apollo Healthco, and AHLL. Despite the seasonal impact from the onset of the festival period, focused execution has enabled us to report broad-based growth and resilient operating metrics. Healthcare services business has delivered a 9% year-on-year revenue growth to 3,169 crore. The revenue growth was driven by insurance and cash patients, together accounting for 83% of inpatient hospital revenue. Q2 FY25 had a higher incidence of seasonal medical admissions, leading to a high base. Medical admissions were low in Q2 FY26. The low growth in medical admissions was offset by a 14% increase in revenue from Congo specialties. The reduction in number of patients from Bangladesh has had a 1% impact on healthcare services revenue in Q2 FY26. Surgical volumes grew by 3%, supported by a continued focus on Congo specialties, cardiac, oncology, neurosciences, gastro, and orthopedics, which remain a key growth engine, delivering a 6% volume and 14% revenue growth on a year-on-year basis. Group-wide occupancy stood at 69% in Q2 FY26. As shared earlier, we have withdrawn the ARPOB metric and introduced the average revenue per patient ARPP as a more accurate measure of realization. ARPP in Q2 FY26 was at 1,73,318, recording a growth of 9% through a combination of better clinical mix and regular tariff increase for inflation. Within the healthcare services business, we have delivered an ROC of 30.3% with a balanced ROC across all geographies, Metro, Tier 1 and Tier 2. Moving ahead, Apollo HealthCo reported revenues of 2,661 crores, marking a 17% year-on-year growth. Apollo Health and Lifestyle revenues also increased by 17% to 474 crores during the quarter. Private label and generics were at 15.2% of total pharmacy revenues. Our digital platform, 24/7, added 3 million new users, taking the total to 44 million users. The platform GMV was at 723 crores, growing 16% over the same period in the previous year. The pharmacy distribution business in Apollo HealthCo recorded an EBITDA of 181 crores as against 153 crores, higher by 19%. Losses in the digital vertical were at 71 crores compared to 101 crores in the same quarter last year. As a result, Apollo HealthCo reported an EBITDA of 110 crores in Q2 FY26, up from 52 crores in Q2 FY25. AHLL delivered an EBITDA of 50 crore, representing a 21% year-on-year growth, with margins improving to 11% from 10% in Q2. During the quarter, the Chief Minister of Delhi inaugurated Apollo Athena, Asia's first dedicated cancer center for women in Defence Colony. The facility is designed to tackle the growing burden of breast and gynecological cancers and integrates precision medicine survivorship programs and world-class treatment protocols. We also performed a soft launch of the multi-speciality tertiary care hospital in Pune. We continue to make steady progress on our other expansion projects across key metros, including Kolkata, Hyderabad, Bangalore, and Gurugram, with commissioning lined up in the upcoming 12 months. The statutory processes for the restructuring within Apollo HealthCo and the KeyMed merger continue to proceed as per plan, and we remain well positioned to capture the full benefits of scale within Apollo HealthCo. Half-year H1 FY26 results. The consolidated revenue for H1 FY26 stood at 12,146 crore, a growth of 14% on a year-on-year basis, supported by balanced expansion across all three verticals. Healthcare services revenue at 6,104 crores, up 10% year-on-year, driven by continued traction in high-end specialties and improving clinical mix. Apollo HealthCo delivered revenues of 5,132 crores, registering an 18% increase year-on-year, while AHLL grew 18% to 909 crores. Consolidated EBITDA for the first half was 1,793 crores, reflecting a 20% increase year-on-year. PAT stood at 910 crores, up by 33%. This is a strong half-year performance, which reinforces our ability to sustain growth momentum while maintaining financial discipline and operating efficiency. Let me close by saying that our Q2 and H1 performance underscores the continued strength of Apollo's integrated healthcare ecosystem and our commitment to delivering clinical excellence at scale. We remain focused on deepening our leadership in core healthcare services, accelerating digital and retail health, and expanding our network through strategic capacity additions across key markets. With a disciplined approach to execution and a clear roadmap for growth, we are confident of enhancing our performance in the coming quarters and will continue to create long-term value for patients, partners, and shareholders. On that note, I would like to hand it over to the moderator and open the line for questions. I have Krishnan, our Group CFO, Madhu Shashidhar, CEO of Hospitals Division, Madhivanan, CEO of Apollo HealthCo, Sriram Iyer, CEO of AHLL, Obul Reddy and Sanjeev from Apollo HealthCo, We'll take all of your questions. Thank you.
Thank you very much, ma'am. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Binay Singh from Morgan Stanley. Please go ahead.
Hi team, thanks for the opportunity. My first question is how to think about organic growth for hospitals, keeping in light 2 points. First is that the Bangladesh impact incrementally will go away, so that'll be 1% positive. Secondly, there's a lot of news flow on insurance pricing that hospitals are planning to keep steady for next year. So keeping both these, could you comment on this and then guide on organic hospital growth for next year? Thanks.
Yes, I think we are quite confident that we will get back into 30%. We say this because Bangladesh, at least 60% has started coming back in October, and we believe that we will mitigate the impact of losing one territory. Also, we're exploring new markets, including the northern markets in Uzbekistan, etc. So those that are surrounding markets, Africa, some with Indonesia, Iraq, new markets added to Bangladesh coming back will definitely give us an upward trajectory. With regard to insurance, we continue to stay in dialogue with the insurance companies, and I think that there is a very good way forward because all of them represent different parts of the value chain, and we recognize how important it is for us to cooperate and work together.
And on the pricing front on insurance also, I'm not sure about this commitment that you're talking of. Typically, as you know, in any case, our insurance contracts are once in 2 years. So by that definition itself, we don't get a price increase every year. So what happens is, every 2 years it gets reset. So, if you have reset the contract this year, it's the same pricing applies for 2 years, while our inflation is always annual, which So that's the way it has been working, and it's the same way that it continues to be. Certain contracts will come up for renewal this year, certain others will come up for renewal the next year. So it's a rolling, contract renewal that works across the system. It continues the same way.
And Vinay, if I can add, even within this quarter, you will see that there's, I think Ms. Sunita also spoke about it, a significant improvement in the quality of the revenue. There has been an increase in the complexity of cases with substantial improvement in our Congo specialties and high complexity cases. We've also invested a lot in the past 2 quarters in building solid programs and heavily into recruitment, especially in our mature units. So I think these will all add to that organic growth that you were asking about.
Thanks, team, for that detailed answer. Secondly, just one question on the presentation on slide 16, where we talk about capacity expansion. Here we used to say FY26 commissioning number. Now we are putting it under FY26-27. So is there any change in ramp-up plans? Just to check that for next 2 years.
So the way we are looking at it is this. Today, if you're looking at it, I'll comprehensively handle this slide because there are other couple of questions also which come up. One was, 6 new hospitals is what we are looking at adding, in the next year, this year to next year. This coming quarter, you would see us started commissioning. We already soft commissioned the Defense Colony Cancer Hospital. We have also soft commissioned Pune. So you will see that Pune and Defense Colony both will start. We will start reporting numbers from this quarter itself, which is Q3. Come to Q4, we will be starting the Sarjapur Bangalore Hospital as well as Calcutta. Come to end of Q4 or early Q1 is when we are looking at Hyderabad, because there are in Hyderabad, as you would have seen, we have the cost has gone up by 35 crores because we have now decided to add a comprehensive oncology program also there, which includes the radiation therapy equipment, which results in us that requires some more time to build. So which is why it will be more around Q1. Even in Gurugram, it will be more around Q1 because we have enhanced the overall facilities and doing some more of private rooms, etc., in line with what the market demands. So the way you should look at it is Q3, Q4, Q1. In that order, we will be looking at starting all these 6 hospitals. The balance brownfield, which also something that we have now added. We have also started work on Jubilee Hills and Secunderabad now. So all those brownfield expansions will also come next year, in mid of next year, etc., mid to end of next year.
And in Bangalore, Malleshwaram and Mysore expansion, work is started on both. So you should see it happening next year. We will open out those beds.
So by end of next year, all the census beds that you're seeing, should be fully operational. Of course, as you know, we start 50% as we start and then keep ramping up. So next year is going to be quite a busy year for us, and you will see all of these, fully commissioned by end of next fiscal.
Great. Thanks, team. Very clear. Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 2 per participants. If you have a follow-up questions, please rejoin the queue. Next question is from the line of Damayanti Keria from HSBC. Please proceed.
Hi, good morning all, and thank you for the opportunity. My first question is again on hospitals. So between now and end of FY27, as you indicated, 6 hospitals coming up. So I understand 26 Pune will be key addition, and then majority will be coming in 27. So if you can comment bit on the impact on EBITDA margin trajectory due to the new costs coming up.
So Pune and Defence Colony is this quarter. Sarjapur and Calcutta is also Q4. So it's from an FY26 perspective, FY perspective, these 4 hospitals come in FY26 itself, and Hyderabad and Gurugram will come into the next year. We continue to believe that next year, overall EBITDA losses from these hospitals should be around the 150 crores number, which is what would be the EBITDA losses from these hospitals. But we will come back to you closer to the Q3, Q4 to, once we commission some of these hospitals, but we don't expect it to be higher than that.
And these losses include fully built up costs, right? Once you commission a unit, most of your doctor costs, your facility costs, etc., are already in place.
Yeah,
that's correct.
Okay. My second question is on your spend on Apollo 24/7. So last 2 quarters, I think somewhere 94, 96 crore kind of spend, which we have seen. So what kind of headroom you have to reduce from these levels, or these are more sustainable cost levels to look at?
Madhi?
Yes, ma'am.
Madhi?
When you say spends, you mean... Yeah, can you hear me?
Yes, I can.
Am I audible?
Yeah, you are.
Yeah. So Damayanti, when you say spends, it's a cost structure. So a big chunk of the cost has been, so as an individual entity, we have reduced it quite a bit. So this would be in a way a new normal. But as we get into the program of aligning between the 3 entities, KeyMed, Apollo Pharmacy, PD, and we will see a little bit more of synergies coming through as both the teams will merge. But our biggest expenses are primarily on the marketing side, so which has it's come to a very rational level. So you'll see some more, but that will typically happen from the next financial year. Q3, Q4, more or less, there is nothing much more to bring down on the spends line. So focusing on the revenue side of the story.
Sure. And the target of achieving cost break-even for 24/7 by end of this fiscal remains, or we can...
We are on course. No, we are on course. There might be one hiccup in the form because we are investing reasonably strongly on the insurance side of the business. We are seeing some very good traction. We have completed some of the integration with the health side. We are exploring the life. So there might be a little bit of a hiccup here or there, but we are on course as we speak.
Okay, that's helpful. I'll get back in the queue.
Thank you. Next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity, sir. Again, just on Apollo 24/7, on the GMV side, probably 7,200, 300 been sort of a stable for last 3-4 quarters, while you already highlighted in terms of how the cost measures will help in getting the better profitability. If you could, share your thoughts on how do we think about improving the GMV?
So you have to look at the GMV from three perspectives. One, how is the pharmacy business growing? Within the pharmacy business itself, there were two levers. One, what we call as a platform revenue, which is primarily driven by Apollo 24/7, the app and the website, which has been growing at a very good pace of around 30% on a year-on-year basis. And on a quarter-on-quarter basis, we are in the range of around 5 to 7. In this quarter, we actually exited out of a few B2B businesses because we were constrained to walk out of them because of some of the bottom line related and our quest of trying to break even. So this GMV reduction, that's why you're seeing just a 16% growth. That's coming primarily from the pharmacy side. So and that was one reason. And the third was the GST, because earlier we used to report the total numbers on a total GST basis. Given the advantage that we have received as an industry, it has shaved off around 6% from the top line. This does not impact us on the bottom line side. So that's the only reason. So you will start seeing the increase on a quarter-on-quarter basis because now it's a new normal.
Got it. In terms of any other, let's say, business aspects which can, so GST is more like a transitionary period probably, but any other aspect in terms of to drive the GMV?
No, we will continue to grow what we have, our original guidance of growing between 25 to 30% on the overall. Our diagnostic business is picking up. In fact, we buck seasonality. So we will be back on course again on that side of the story. On the hospital side of the business that we try to drive on the consults, we are relooking at our approach so that we can become much more relevant in the overall scheme of things as far as the hospital is concerned. And the last one, the insurance will, like I told you, will take a little bit of a time, but we have started clocking in some good numbers with just two cities in fray, which is the NCR and Hyderabad. You will start seeing the new businesses picking up from Q4 onwards.
Okay. So just on the hospital side, the Karnataka cluster has seen IP volume decline. If you could share.
So Karnataka region, there was a drop in the medical admission significantly in that region particularly. If you look at the drop overall of the 6% that we reported in this region, there is a medical volume drop of 15%, while surgical volume went up by 2% and cath also went up by 13%. So I think it is really the seasonality, seasonal medical admissions that we see in Q2 in Karnataka, or we saw in Q2 of last year, definitely was not there this year. But otherwise, which is why if you look at the average revenue per patient in this region, it's gone up by 14%, because the balance cases, which is surgical and cath, that makes as a higher ARPP compared to the ARPP of medical admissions. So clearly that's the reason, but so the core continues to remain intact. Dr. Madhu?
Yes, that's correct. And if you trace those medical admissions back to the last year, it was almost entirely a very bad dengue season, which we have not seen this year. So I think it is the year-to-year seasonality. The remaining volume that we do, especially in the high complexity specialties, continues to be strong, and I think that growth will continue into this quarter.
All right, sir, that is helpful. Thank you. That's it from me.
Thank you. Next question is from the line of Harith Ahmed from Avendus Spark. Please go ahead.
Good morning. Thanks for the opportunity. My first question is on margins for KeyMed. We've seen some softness there, around 30 to 40 basis points decline on a YY basis. In the past, we've talked about some restructuring and buyout of minority stakes, etc. within KeyMed. Is that activity over? And how should we think about KeyMed margins, and especially in the context of the overall margin guidance of 7% by 4Q next year?
Sanjeev?
Yeah, may I take this question? Yeah, thank you, sir. Yes, you're right in saying this Q2 we had slightly drop in the EBITDA margins for KeyMed, but this is only one time integration and scheme related expenses which got accounted in Q2. So you wouldn't see the same happening in from next quarter onwards. And as suggested earlier also, over a period of time, you're looking at 20 to 30 basis points over and above 3.1%, which normally used to be KeyMed EBITDA since last 2-3 quarters, to be happening as we move forward. As far as the overall 7%, which I think you're referring to the guidance of Q4 FY27, wherein we are suggesting about 25,000 crores of revenue run rate with a 7% EBITDA. I think we are hopeful that we should be able to hit that mark, and progress is there quarter on quarter. This quarter, if I look at the H1 of FY26, we are at about 9,200 crores of turnover, which makes it to about 18,000 crore plus, and EBITDA is 4.4%. I think once we get into break even, the margin should come closer to 7%. If you exclude the digital losses, we are already at about 6.2%. And as Mr. Madhivanan suggested, that somewhere in Q4 or we'll be very near to break even. So I think after that you would start seeing overall EBITDA also to be in the range of 6% plus, and 1 year forward we should be in the range of about 7%. Thank you.
Got it. My second question is on specialty care segment within AHLL. Growth has been a bit soft there, and you called out competitive headwinds in the segment. So trying to understand which verticals within specialty care we're seeing higher competition, and what's the outlook here?
Yeah, Sriram?
Ma'am, the line for Mr. Sriram got disconnected.
Okay, could you repeat the question? We'll take it.
Yeah, so I was asking about the specialty care segment within AHLL. We've seen a relatively modest growth there for that segment in this quarter. And in the presentation, you called out competitive headwinds for the segment. So within, I understand there is, multiple verticals like Cradle and Spectra within specialty care. So trying to understand which vertical we're seeing greater competition and what is the outlook here.
So in terms of competition, clearly the only one that has serious competition is diagnostics, because Spectra there is no competition, and in Cradle it is only where our cradles are present. There's very little competition, except in Karnataka where Cloud9 has a big market share. Having said that, I think that our focus will be on primary care. It will continue to be focused on growing diagnostics as well as growing the clinics, which is really primary care, creating clinics with GPs at the center to be able to look after communities and act as a funnel to Apollo hospitals. So this is what we are currently focusing on. And of course, the dialysis continues to do well.
Got it, ma'am. Thank you. I'll get back in the queue.
Thank you. A reminder to the participants, please restrict your questions to 2 questions per participant. Next question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. Ma'am, I think you mentioned that you expect growth to get back to 13%, for the healthcare services business. This, I assume, would be organic growth, and, the expansion should add to this growth. Would that be a fair assumption?
I think over, a 3-year period, you will see that there is headroom for growth within the system. This should result in 13% growth in the existing beds and an additional 5% coming from new beds in the next 36 months.
the 5% will get added over the next 3 years. Would that be right?
Next 2 years you'll see another 5% come.
Okay, got it. And on the GMV growth in the digital business, could we get a breakup of, what would be the split from GMV in pharmacy, in insurance, new businesses, and how should we see this, let's say when the business achieves break even, what would be the mix of that GMV? Just trying to understand how the revenue and margin should move based on this mix.
Yeah, let me not give the exact breakup, but typically the pharmacy business constitutes the biggest chunk out of this. And this is the one which has a direct impact on our profitability, because the unit economics is what drives this break even that we are working towards. So any kind of a growth in GMV, which is on a profitable basis at a unit economics level, straight away contributes to a break even. So the way to read it would be what percentage of our total GMV is being contributed through the e-pharmacy business. That's layer number one. Diagnostic business is again directly linked to GMV, albeit the numbers are not as large as that because the margin structure is reasonably better. So that constitutes the second portion. The third layer of business, which is the hospital business, is predominantly fee-driven. We are more a tech services and a lead operator for the hospitals, being driven through the digital mechanism. So that is more or less independent of the GMV growth. As far as insurance is concerned, this is more of the GMV equivalent in the financial services industry is gross written premium, which is what we log in. So here again, because we are approaching a model wherein we want to make insurance as affordable as possible, we are actually promoting a more EMI-driven kind of a business in this model. So here again, we will start reporting the collected premium into our number. So these are the four layers. E-pharmacy, the biggest constituent. Diagnostics, the second big one. The hospital contribution of the GMV is primarily driven by fees and therefore will not make such a big play. And the fourth one is the insurance business, which will come to the party in another maybe a quarter or so. And like I said, 55 to 60% of the total pool comes from the pharmacy.
And from a profitability perspective, the increase, I mean, for us to improve margins to, let's say, the 20%, the pre-operating margin for 20-25%, would essentially then depend on pharmacy business growing, or would it, with as insurance picks up scale, that would be a bigger driver of the margin?
Oh, no, pharmacy is a current driver of the business because that's a reasonably established business. Insurance at this point of time is still on a break-even mode. Once that gets into break-even mode, it starts contributing to the profitability in a much more disproportionate sense. But to read it for the next 2 quarters, I would focus on the pharmacy business.
Understood. Thank you so much, sir.
Thank you.
And just to highlight, sorry.
Sorry, sir.
No, I just wanted to highlight one more point. As we speak, just to give some confidence back to how our path to profitability is growing along, all the 3 lines of businesses that I spoke about, pharmacy, diagnostics, and consult business at a CM1 level has turned positive, each one of them at an individual level. Our immediate objective in the coming quarters is to drive the CM2 and then the CM3. Like I told you, maybe the insurance business will take a little bit more time, but we'll bring that also up the curve.
Thank you. Next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Yeah, good morning. Thank you for taking my question. I know you mentioned about the seasonality and the reason why the utilizations fell from 73 overall to 16, and I get it, but I'm just trying to look from a forward path perspective. Right, ALOS has been consistently declining. This is obviously as we are able to be more efficient in terms of our processes and stuff. But is there a theoretical lower limit where we reach on ALOS? I think that is question one. And my larger point being, when will we start seeing better volume growth? Because utilizations have been below 70. And is there a plan where at some point of time we needed to go to 70, above 70 at all, or our business model does not need to be like that? I'm just trying to compare ourselves with some of our peers whose utilizations are higher.
No, so 70 is definitely a benchmark that we're looking at. Our loss has dropped by 7% because the use of new technology, whether it's cardiac where we have minimally invasive, as well as robotics. So this is really driving down errors and allowing us to, discharge patients much faster. With regard to occupancy, I think that 70% is definitely the target that we hope to reach. Having said that, we are looking at improving payer mix. We're focusing on the corporates, which earlier I think, we had not put enough focus there. Lots of focus on retail as well as, international coming back to us. With some of these initiatives, I think that we will move closer to 70. Having said that, our metro hospitals have actually crossed 70, and in October, in October itself, we are looking at higher occupancies coming from metro. We have a separate plan for the non-metros. You want to add?
Yes. So it's a good question, and I'll take the ALOS question first. A lot of, as Ms. Sunita said, the benefits that you are seeing are the results of us putting in, driving our digital transformation, putting in electronic command centers in each of our hospitals and reducing variability. And I think we are probably not going to see sustained reductions in ALOS other than a few of our units that still need to catch up. I think where this puts us is in a place where we can drive utilization higher. We can more easily take on much higher levels of occupancy with less variation in and more predictability, because the barrier to driving occupancy to much higher in acute care hospitals is the need for beds when there is high variability in patient admission. I think our digital transformation allows us to address this more efficiently. So clearly we are targeting much higher levels of occupancy. And in some hospitals, it is possible to drive it to 80% and higher, especially when we are targeting more elective and semi-elective patients.
Got it. Very, very helpful. And just a second question on the EBITDA loss guidance that you shared for the 6 hospitals. I heard it's 150 crores. I think, Krishnan, you called it out as 150 crores. So just want to understand, does this hit us in the full fiscal 27? Is it spread around, just from our past experience, 2015 to 2018, where some of the bed additions at that time led to like very volatile margin trajectory? Is there something that we're doing this time differently to ensure even some of the financial metrics are a little bit smoother, if I say so? Thank you.
No, surely we are. These are all in existing markets. So if you look at places like Delhi, Hyderabad, Calcutta, etc., we have a very clear plan on how we can ramp up. And as we have said, our internal target is to get all of them to break even in 12 months. And given that it's all going to be, if you look at it, it's going to be first 2 hospitals in Q3, followed by another 2 in Q4, and then Q1. There is a kind of, it's being spaced out a bit. And yes, in the first half of next quarter, there could be a bit higher than this. It would not be equally spread, but then first half would be a bit higher and then it will come off. But we will start showing that separately in our earnings presentation as we have done in the past as well, so that you get the confidence that we are in track to achieve these numbers that we have stated.
And I believe that it won't be a significant impact on EBITDA margins because we'll have, strong cash flows, EBITDA of close to 3,000 crores as we open these new hospitals.
And as Dr. Madhu said, the existing hospitals also, we have room for growth and we are working on that. So that also should start supporting in the next year on the, on the volume as well as ARPP driven growth. So we are working on both.
Got it. Thank you and all the best.
Thank you. Next question is from the line of Vinopati Parampil from Elara Capital. Please go ahead.
Hi, good morning to all of you. Most questions answered. One on the insurance business. How are you selling the policies now? Is it mostly online?
Madhi?
Yes, ma'am. It's a combination of all the three. Our first attempt is to try and sell it digitally because we have no intentions of going and spending on marketing spends and trying to get new customers. So we are primarily focusing on this 1 crore plus customer and the 44 million registered customers. So it's predominantly driven by digital. However, insurance being such a complicated, these are small ticket items sell very well on digital. However, the moment the ticket sizes go into the range of 20 to 30,000 rupees, people seek out an assistance. So we are building a capability of a call center, which is right now 300 seater. We intend to take it up to around 500 as a capacity building, and the productivity norms work out. So think of it as a combination, an omni model of leads and some business through digital and the corresponding ones through a call center mechanism. We are not in the process of putting any kind of a manpower on the field. If at all any, it will be more from a services perspective, but that's not the channel that we are focusing on.
Okay. And do you plan to promote it through your physical pharmacy stores at all?
Here again, we will come out with some specific products, such as, let us say, a vector insurance or a personal accident, which will be done more under the POSP model, but that is expected only around the next financial year. We would like to get the basics right first and then go into some of those models, in which case, maybe out of the 7,000, we might identify 1,000 odd outlets without putting a person on in the place. We are not intending to increase the cost, but we'll work very closely with the APL outlets, with the right kind of outlets to sell products which can be sold as a part of the normal journeys and flows.
Got it. And in healthcare, when you say the diagnostic business, it is sourcing of diagnostic business, right? Your backend would be AHLL?
Correct. So we are primarily into originating business for them. The final labs, etc., rest with AHL. So think of us as a digital arm for AHL.
Got it. And finally,
Sorry to interrupt, Mr. Binu. May we please request you to rejoin the queue, sir?
Sure, thanks.
Thank you, sir. Next question is from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Hi, thank you for the opportunity. The first one on the hospital business, if you look at the EBITDA margin in this quarter have remained same despite strong ARPP growth of around 9%, and you also suggested that the acuity mix is kind of positive. So what is driving profitability to kind of remain same? And since EBITDA margin in existing hospitals are not expanding despite the strong ARPP growth, how comfortable are we with offsetting the losses from the new units that we are expecting over the next 4 quarters?
So with regard to the ARPP growth, we showed a 9%, which really indicates that we've really moved up in terms of complexity. To move up in terms of complexity and to make sure that we are prepared for the new hospital expansion, as well as getting new volumes into the old, there was considerable amount of 67 crores spent on doctor hiring. I think, we have created an organization structure that will make sure that we will grow in terms of, we have improved sales and marketing, and there is certain costs attributed to that. We've created teams that strengthen our projects division, as well as, started recruiting for the new hospital. So it's a little of the cost coming ahead of the opening, which is why it seems, it is at 24.6, it is flat. But going forward, we should see the benefits of all of this. And therefore, the impact of the losses on new hospitals will remain at 140 crores to 150 crores.
So also, if you look at it in a very different manner, if last year, same quarter, we did see an increase and spike in the margins because of the medical admissions that we spoke of. Otherwise, full year margins were at 24.2% full year. Whereas if you look at H1 of this year, we are at 24.6. So the way you can look at it is, we have taken steps which is evident in terms of, ensuring that there is a margin flow through which happens because of the ARPP, etc. You're not seeing it because of looking at it on a quarter-over-quarter basis. But when you look at it on an annualized basis, you will see that this year margin should be higher than last year reported
And
margin.
also there is a plan to cut costs by about 120 crores. I believe that we've achieved about 60 crores of it. So clearly this will continue to support the EBITDA margins in the range of 24.6 to 25%.
And this 120 crore cost cutting, is it related to hospital business, and which are the areas within hospital?
So it's a broad-based approach to managing our costs. We found opportunities in our materials management and supplies. Certainly, we are looking at how we utilize our HR more efficiently, given that we've made huge commitments and huge investments in our digital technologies. Therefore, that is driving a lot of efficiency in how we do our work. So as we bring online new hospitals, rather than recruitment, we are actually looking at redeployment that is leading to better efficiencies in how we use our HR. Beyond that, I think there will be some opportunities to reduce our ongoing costs in IT and some other costs as well.
Sure, sir. My second question is on the
Sorry to interrupt, Mr. Kunal, may we please request you to rejoin the queue, sir? Thank you. Next question is from the line of Avnish Burman from Vicaria. Please go ahead.
Yeah, hi, good morning. Thanks for taking my question. My questions are on KeyMed. I wanted to know that because of the GST change that happened in this quarter, how much sales did the business lose? As in only the KeyMed. How much sales loss was there?
Obul, please take that.
You will see somewhere about 4% of the sales revenue coming down because of the shift from lot of 12% items into 5% items. Something like entire 12% GST slab is removed, and that consists of almost 70% that move into 5%, and you expect about 4.5% revenue drop.
4.5%. Okay. And is the inventory back to normal at the customer end, at the company end?
It's from day one we have been managing that. We have planned it well, and the transition was smooth that including our 700 front-end stores, we could implement the software and see the new billing is done at 7 a.m. on 22nd, and everything is passed on to the customer as per the regulation.
No, my question
even
was
from our possibility.
Yeah. My question was that in that interim period, we saw the inventory coming down at the retailer level. Is that back to normal?
That's back to normal.
Back to okay. And one question on the margin compression. We've seen KeyMed margins getting compressed by about 40 basis points sequentially and YOY. Is there a reason for that?
Sanjeev, you have already answered, right?
Sanjeev, you can answer that again.
Yeah, okay.
So Sanjeev answered that.
This is only one time. This is related to the scheme and integration related expenses, sir. And you wouldn't see that happening in the next coming quarters. Even if those expenses are there, they'll be very low. They'll not be material to pull down the EBITDA percentile. But Q2 has happened because of these expenses.
Okay, thank you so much.
Thank you.
Thank you. Next question is from the line of Kritika Damani from Prospero Financial Solution. Please go ahead.
Hello. Yes, congratulations on another strong quarter. I had a question about, we are seeing that the healthcare services has grown 11% in this quarter, and your average revenue per patient is up 11%, though the occupancy has eased up to 69%. So in prior quarters, you have mentioned balancing occupancy and realization. Could you elaborate whether this quarter's average revenue per patient growth was primarily led by tariff revisions or richer case mix or structural shift in patient segments?
So most of the tariff increases had already been realized previously. Almost all of our improvement in the average revenue per patient has come from an improvement in our case mix. And that is evident across all of our higher complexity specialties, including cardiology, neuroscience of gastroenterology and orthopedic. And it has also been a broad-based increase in ARPP, primarily in large hospitals and metro cities, but across pretty much every single geography.
All right. And the second question is that you have highlighted that the artificial intelligence-led interventions in oncology, radiology, and stroke care, beyond their patient outcomes, that are you seeing any measurable operational efficiencies? Because how scalable are these models across your own hospitals?
So thank you for that question. Yes, we are using artificial intelligence technologies very broadly. I think today, if you go to our front-end website, there is an artificial intelligence agent that connects patients with complex medical conditions to the right doctor and allows them to book appointments. That business, which is from the website, grew from last year to this year by 318%, mostly due to the adoption of very scalable AI technologies that are patient consumer-facing. Internally, we have, as I said before, we've implemented command centers, digital command centers that have real-time intelligence, can see patient flow in each of our hospitals in real time. And on top of that, we are layering agentic technologies to autonomously anticipate patient issues and proactively solve them. So I think there is tremendous potential for us to have better efficiencies through the use of AI technology.
All right. Thank you. That was very helpful.
Thank you. Next question is from the line of Lavanya T from UBS. Please go ahead.
Oh, hello. Good morning, everyone. So that's a clarification. So you mentioned that Q2 there was an increase in costs related to hiring for hospitals next quarter. So is it right to assume that this was related to the 2 hospitals which are expected to open in Q3, and there will be jump again in next quarter once the hiring for the other 2 hospitals to open in Q4 will happen? Is that right way to think?
No, I think some of it is correct. For example, in Pune, there is a HR cost and a hiring of doctors, and we're just about to do the full-blown launch of Pune. So we do have to hire some of our doctors ahead of the opening. This will happen in Gurgaon as well. And I think that, for this quarter, we've captured some of the costs. There will be a little additional cost that will come in March.
Okay. But for the hospitals which are expected to open in Q4, there will be hiring which will happen ahead, right? So that should come in from Q3.
Some hiring, yes.
Okay.
But it is not a huge number like we do the figure for this year, for this quarter. So it's not huge, but it's there.
Okay, got that. Thank you.
Thank you. Next question is from the line of Madhav from Fidelity. Please proceed.
Good morning. Thank you so much for your time once again. Just wanted to check that, we are at about 24.5%, 24.6% EBITDA margin in the hospital business, but we seem to have already added some of the OPEX for newer beds. Could you give some sense in terms of, what the base network margins are, adjusted for some of these costs which you're already building in for the newer hospitals? And then those margins, like you said, you'll report the OPEX from some of the newer hospitals separately, which I think is a good idea. So the base network margins, in your view, how do you think that could progress over the next couple of years, excluding the new beds?
So in the base, we would like, the approximate cost which is there in this quarter would be roughly around 10 crores in this quarter, but next quarter onwards, you'll see it increase. But we will show you the split from the next quarter of our established hospitals and the new hospitals. Both the revenue and the EBITDA, such that, it's clear for you on how the existing or the established is progressing, as well as the new is coming in. So that will clearly give you the perspective. As of now, there are costs of roughly around 10 crores, which is built in, and on the doctor side also, the revenue will be almost around 5 in the doctor now. But you will see that it's being separated out from the next quarter. We are, clearly hoping and, working on ensuring that we should get the overall margins over the 25% in the next year and even higher on the established hospitals, which is the 24.6, which is the combination of both revenue as well as costs that we spoke of.
So the 15 crore cost, which is built in quarter two, that's roughly 50 basis points, right, of our revenue.
Which is correct.
Right. So basically, the base network is above 25% in quarter two already, right?
So you are right. You are right in the way that you are looking at this. So but once we start splitting out from the next quarter, you will see the exact difference coming in.
Yeah, and that 25.1 which we are at in quarter two, just that number, like of course excluding the new beds, that do you think there is scope to expand those margins over the next 1 or 2 years? Yeah.
Yes, clearly there is, because there is headroom for growth. We are working on the clinical program, and clearly we would the internal target is to take it higher by at least 100 basis points.
Okay. Maybe just one more question. Like,
Sorry to interrupt, Mr. Madhav. Sorry to interrupt, sir. May we please request you to rejoin the queue, sir? Thank you. Next question is from the line of Nitin Agarwal from DAM Capital. Please proceed.
Hi, thanks for taking my question. Ma'am, on, recently there has been a significant hike in CGHS rates by the central government. So the question here is that, does these hikes in CGHS, I presume it will be followed by other central government agencies, does that change our perspective towards government business? And two, how much of an impact does it really have on our business right now?
So yeah, it's at least a marginally better number that they have given, but from a base perspective, it doesn't change the views that we have been having on this business.
Okay, thank you.
Thank you. We'll take a last question from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Hey, thanks for the opportunity again. Just on CGHS rate revision, have we kind of done an exercise where we can you can suggest what is the average rate hike that we have received or the government has given for the key therapies like onco, cardio, etc.?
So your point is correct. See, there are certain specialities where they have increased the prices reasonably. So cardiac, onco, ortho, etc. would be reasonably better now. But the point is, when you empanel yourself for CGHS, under the rule book, you have to take whichever patients they send to us or whoever comes to us. You can't deny admissions for the others, and it's not appropriate that we take that route unless the government allows us to do that. Then we could actually have selected, some of these specialities and worked on those specialities. So it's a bit of a difficult way of doing that. It's not something that we have been doing in the past either. So with that, it's very and then when you look at the overall average realization and compare it to the insurance business or even the cash tariff, it's still a good 65% discount to the overall realization that we have. So that is, we don't make that kind of margins, that.
Sure, sir. Sure. Thank you. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to the management for the closing comments.
Thank you, ladies and gentlemen, for joining this call. I do want to say that the management is always available. I could see there were many more questions that needed to be asked. So please feel free to reach out to us. We are encouraged by the robust growth in revenue across all verticals and the EBITDA we've delivered despite seasonal market factors. Our integrated healthcare ecosystem spanning hospitals, diagnostics, pharmacies, and digital platforms will continue to deliver balanced growth and improved asset utilization. Our footprint expansion will go on stream as planned and will add to strength to our clinical delivery as well as to volumes and revenue growth. We really appreciate your continued interest and look forward to communicating with you throughout the year. Thank you.
Thank you, ma'am. On behalf of Apollo Hospitals Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.